I have with me Carlos Ghosn. The man needs no introduction whatsoever, and he has a very successful selling car in India right now, the Kwid. Mr. Ghosn, thank you very much for joining us here in Davos.
Thank you.
Let me start by asking you to characterize the global economy right now and where you see growth for the automobile business. I'm wondering if it's just the US and India?
Yeah. Well, I think overall we see 2016 as a year of growth, moderate growth.
Wow.
Moderate growth overall. We're talking about between 1 and 2%. But this growth with a lot of discrepancy. That means some markets are going to be doing well. India is one of them. We're expecting a significant growth in India.
The Kwid is doing very well, as we said in the introduction. And you have managed to, localize the manufacture of it almost to 98%, which very few foreign car manufacturers have been able to do in India, if at all. So I think the question really is how you've managed to do that and what the strategy is here on.
You know that the Kwid is the first car on a completely new platform, we call the A platform. And I knew from the beginning that the only chance of success of the cars coming out of the A platform was to localize the platform in India. Put the whole team in India, in our Indian engineering center in Chennai, and push for a maximum level of localization, which means that if we cannot localize, we don't do. And that's how, because we have designed the car to cost and we have designed the car for a very high level of localization, we were able to reach this level.
Do you expect to bring in the electric car at all to India, the plug-in car? The Indian government is clamping down, or not the government, the courts have clamped down on diesel car sales, as you may have heard in Delhi, a certain category of diesel car sales, in an effort to curb pollution. But we really haven't started the conversation in India on electric cars.
No, I agree, because in fact electric cars are still too expensive for what the market can expect. We're seeing the same problem in China, where the state-of-the-art electric cars are not selling. So what we're trying is to come with a design-to-cost kind of electric car at an acceptable price for the consumer. So India is a very interesting market in terms of electric cars, but it would be absolutely not good to introduce a car at a very high price. We need to work more into reducing the cost and introducing cars with a very modest price in order to have any chance of success. And we're facing the same problem in China, by the way.
Okay, one final question, Mr. Ghosn, and that has to do with autonomous or self-driving cars, as they call it. You're on track to deliver, I think, almost 8 versions of that by 2020. I'm just curious to know how you see technology changing the fortunes of the automobile industry. And one final question, which is, do you see the autonomous car coming to India around that time as well?
I think first that without any doubt, autonomous car and connected cars are part of the future in all markets. So the question is how much time is going to take to reach the different markets. Well, this depends on the technology, but the technology is moving very fast. I have said already that we're going to be introducing about 10 cars before 2020 with different degrees of autonomy, and 2020 is fully autonomous car that can be, drive in cities. But we also depend on regulation. That means, that today the biggest hurdle is going to be to convince the change in regulation, allowing you to have an autonomous drive and benefit with the connected car. So yes, it will come to India when it will depend less on me than on the regulator in India.
Who's your biggest competitor? Will it be another auto company, or will it be in the future someone like Google?
No, I think it's going to be another auto company, and it's difficult to see who it's going to be, because there is often a big discrepancy between what automakers declare and what they really do have, or they really can mass market. That's why, to avoid this, we are systematically showing our prototypes and calling the media to try drive the technology so they can see that there is no gap between what we say and what we are able to do.
The mood, like I've been telling you for the last few days, is relatively somber, but for the private equity industry, falling markets is always good news, because then assets are cheaper to buy. Let's speak with one of the better-known private equity faces here in Davos, Stephen Pagliuca of Bain Capital. Thank you very much for joining us, Mr. Pagliuca.
It's great to be here again.
I wanted to know what you make of the volatility we've seen in markets, or in fact, why volatility, the downward spiral these last few weeks?
Well, I think you remember when we talked last year, I think we encapsulated the discussion by saying that it was a year to proceed with caution, because the markets were valued highly. So I think what you're seeing now is a correction, if I had to guess. not a systemic meltdown. I don't see any evidence of bad loans or subprime or some of the things that drove the 2008 crisis. I think it's a correction. The S&P levels, I think, as of today, are about at the median of what they've been for a long period of time. So it's a correction, not a systemic crash, in my opinion. In private equity, we are fortunate in that we can take the long view, and so our company's values don't fluctuate up and down, with the daily market price. And we buy companies to build them, as you know, and transform them for the long term.
Yes.
And we can, at the end, take them public or sell them strategic at the right time for the company and for the shareholders.
Okay. You said that you didn't think this was systemic, but there are many underlying structural fears. There's, of course, China and crude oil and commodity prices that's already playing out. But there does seem to be the buzz here that maybe the U.S. is headed towards a recession as well. I'm just trying to get a sense from you on where you see the global economy headed in 2016, and therefore then, what is the investing strategy? Where do you see growth come in? Where would you be looking to put money into?
Well, there's no question that the China situation of having slower growth has impacted the markets. Now, when you step back, it's still 6.5%, 7% growth. That's still a healthy growth rate compared to many places in the world. And I would argue that 15% was unsustainable for a long period of time. They did a fantastic job. Now, they've always managed their economy very well, and I think they can then make their growth numbers. I was in China about 3 weeks ago, and really it's still bustling. It's an economy that's transitioning, as many have, from a export manufacturing-driven economy to a service economy.
Yes.
And the services side is really growing, and that's really propping up that GDP growth. So I think they're doing the right things. Again, I haven't seen any systemic, financial issues. The banks are as strong as they've ever been. They would in fact say some of this market volatility is because the banks are so capitalized now that they can't buy assets like equities or riskier assets. They get penalized against their cost of capital.
Right. So
there's less liquidity in the market. And when there's less liquidity, that causes more volatility. So the banks are very stable. They've made energy loans, but in the CEOs I've talked to, they're not to an excess. They're well diversified. Okay. Many of them are to big companies. So I do not see a systemic crash. I see a correction. And then for private equity, where are we looking? Well, we look at things like technology, how that's changing the world. Yes. So we've looked at financial services companies, payments companies. We did WorldPay. We talked about that 4 or 5 years ago. Yeah. That's been successfully taken public now. It's a very powerful company, in payments. We extended that into other companies in Europe as well, in Italy. So I think that payment space, technology space is a great place to look. United States, healthcare. Certainly healthcare provision systems, technology to make healthcare better, faster, quicker. We're looking at those kinds of things. And also, what people I don't think are thinking enough about is with oil prices going down so much. I think from 18 months ago, we're down something like $70 a barrel. We're in the 30s now, 30 or 28 even. That's a gigantic dividend for the world.
Yes.
And you multiply $70 per barrel by the amount of barrels that the world consumes. That's a huge number in a dividend. And people will use that to invest, to pay off loans. And that will be really positive because that's a big factor of production in anything in the U.S. as well.
What do you make of what the challenges of 2016 will be?
Well, I think that there is a very common feeling within the population of Davos who are here, which is unusual. I think there's a fairly common view. But on the one hand, you've got many of the developed countries actually fairly stable economically. In the United States case, obviously the major economy growing very well. Even the UK is doing well. The Eurozone is showing some signs of action in some countries. Obviously, the slowdown in China and Brazil and some of the other emerging countries is a cause for concern. On the other hand, I personally take the view that both of those economies, different reasons for them slowing down, over the medium to longer term will recover. And so I would be overall optimistic, but I think in the short term there could be some jolts along the way, as we saw earlier this week in terms of the financial markets. And the danger is, if we get significant jolts in the financial markets, significant volatility, it might undermine consumer confidence in some of those other countries. Obviously the standout country is India, which is the star performer amongst the growth countries.
And as far as one can see, India economically looks set pretty fair.
I'm going to get to India in just a bit, but I do want to still ask you about the challenges that the insurance industry faces in 2016.
The challenges in the insurance industry are pretty clear. The first, in the short term, is market conditions. We've got, if you like, a perfect storm. We've got very low investment returns on our invested capital, and if you take Lloyd's, which is, as you know, the global hub for specialist insurance and reinsurance, so it's a high-risk market. We hold our capital to pay claims, so we have to keep the capital in very liquid form. So the returns are very low. At the same time, because of the low interest rates and low investment returns elsewhere in the market, the global funds are looking very hard and see the insurance industry as a very attractive place to invest, partly because of the returns that we've been showing, and also partly because those returns are uncorrelated to other assets. So we've therefore got enormous pressure on premium rates at the same time, and you're seeing that particularly in the reinsurance market. So I think that would be the first challenge we've got. Hopefully it won't be other than relatively short term. I think we're going to have a tough time for the next 2 or 3 years. The second challenge, I think, for insurers is keeping insurance very relevant to the way in which business models are changing. So if you look at the new kinds of risks that are being created by technology, here we are in Davos talking about the fourth industrial revolution. What is that doing? That's creating new kinds of risks. The obvious one much talked about is cyber, but all sorts of other risks, supply chain risks of different natures. So the insurance industry has a challenge to keep up with that.